So this is about a program that's launched about a year ago from Cal HFA, and it is called their Equity Builder Program. And the Cal HFA Equity Builder Program allows for 10% of the purchase price to be provided as down payment assistance, and that is forgiven after 5 years. Absolutely amazing program that when it first launched wasn't viable. We didn't have very many homes at the low end of the price range. We didn't have very many people who could fit into the criteria. And so it wasn't a viable product. In the last couple of months, I've done a handful of these and I'm finding more and more clients that will qualify for it. And that's why I want to talk a lot about it and explain this to everybody, because it is a phenomenal program that's going to help a lot of people be able to qualify to purchase a home. Before I go into the specifics of the program, what I want to take a couple minutes to cover, let's make sure my PowerPoint wants to work. Yay, it did. Okay. I want to talk about the financial benefits of owning a home. And why I'm bringing this up is because a lot of people are worried right now and saying, you know what? I don't know if it's a good idea to own a home. Sure, John, you're going to throw 10% of the purchase price at me as an incentive to purchase the home. And the prices are going to drop by 30%. And I'm going to lose money and it's not a good idea. And I want to address that a little bit. So all right, I'm back. I've got a team member that is helping me run this video, and they are muting people as they come in. But unfortunately, when they hit mute everybody, it muted me. All right, so the fact is that home ownership long-term is still a huge win when it comes to personal finances. And it's the #1 way that people build wealth in their lifetime is through home ownership. And I want to talk about 3 major components of wealth building through home ownership, so that if you're thinking about, gosh, home ownership's for the birds, well, this might help change that thinking a little bit. So the first financial benefit is tax savings. Now I'm going to give my disclaimer. You need to consult with your tax advisor on how much tax savings are going to mean to you. But remember, this is only 1/3 of the benefit. But tax savings, what I did is I ran a simple formula, simple math, and said, what if I bought a $100,000 home at a 6% interest rate, and I put 5% as a down payment? Your interest would be $427 a month that you're paying in interest. And interest is a tax write-off. So you get to write off that interest of $427 a month. PMI, because you're putting 5% down, you're paying mortgage insurance. Everybody says, I don't want to pay mortgage insurance. But in a lot of situations, you qualify to write off your mortgage insurance. Not all, but a lot of situations. And so PMI is another $59 a month in my sample example of money that you get to write off. And then property taxes. So for every $100,000 in purchase price in California, at least, you're paying about $104 a month in property taxes. That's $590 a month that you are spending in money that you can write off as a tax deduction. And I just picked a low to average tax rate of 25%. That means that 590 times 25% is $147 a month saved that you don't get to save if you are a renter. So a huge benefit for the realtors on here. This is huge to talk to your clients about. And for years, we used to talk about it and then we stopped because rates were super low and the tax benefit wasn't very big because rates were so low. Well, when rates go up, it means you get a bigger tax write-off. It's actually a good thing. I'm not telling you want to pay a higher rate, but it is a benefit of the fact that interest rates have gone up. So what's the second financial benefit of owning a home? Forced savings accounts. You notice I haven't talked about appreciation yet, which is huge, and I'll get to that in a minute. But the forced savings account forces you to put money into your own pocket as savings every single month. Now, if you had $20 in one pocket and you took out $10 of that 20 and you put it in your other pocket, you still have $20. You just have $10 in one pocket and $10 in the other. And that's what you're doing when you have a mortgage, when you own a home. Part of your monthly payment pays down your balance. And when your balance goes down, then your equity, or what's left over, goes up. And again, a lot of people that are watching this are real estate agents. You're saying, John, this is super simple. I understand this. Do your clients understand this? Are you explaining this to people who are saying, hey, Bob, is home ownership a good idea? If you explained this, they understand, you know what? Yeah, it is a good idea. You're right. If you don't explain it, don't assume they understand how this works. So they're just comparing, hey, I'm spending $2,500 a month in rent right now, and you want me to spend $3,000 a month to buy a home? I can't afford that extra $500. But the truth is, part of that $500 is going back in your own pocket in the form of principal reduction, which increases your net worth. It increases your equity that you have in the home. So it's critical that we're explaining that. And for consumers who are watching this, buyers who are watching this, it's critical for you to understand how that impacts you, because for every monthly payment, every month you make a payment, part of your payment's going towards principal. Based on this $100,000 purchase price with 5% down at a 6% interest rate, you've got $142 a month. Sorry, guys. Am I back? Sorry, I'm having some audio problems. Can you guys hear me now? Hopefully, yes. Okay, well, I'm sure you can. It doesn't say I'm muted right now. All right, hold on one quick second. Let me fix something really quickly. Okay, so $142 a month is going towards your pocket, into your pocket for every $100,000. All right, so we can move on from here, and let's talk about the third benefit of homeownership. That's the one that most of us talk about. Formatting it up a little bit goofy, but the way the formatting looks, or the way this shows, first of all, appreciation is what everybody talks about. And they say, hey, housing prices are going up, and you're going to make money off of appreciation. And a lot of buyers are like, I don't know. I'm seeing prices kind of come down. I'm not sure if home ownership's a good idea. Well, it's about the long term. It's not about timing the market. It's about time spent in the market. And so when you look at appreciation, I went back, I found this on advisors.visualcapital.com. As of June of 22, they wrote this article that said, on average, the US housing market has seen price appreciation of 4.4% per year since 1991. Okay, so we're not talking about the last 5 years or the last 2 years. We're talking about what, 30 years of appreciation at 4.4%. And we've had some pretty big price drops, including the Great Recession from 2007 on, where we lost a huge amount of value, but it still averages out to 4.4% per year. So appreciation is critical. I personally have found that the coastal states, so the West Coast and the East Coast, they have the most appreciation. Middle America has less appreciation. So this statistic I'm showing is all of America across the board. I have found unproven, but my experience is about 5 to 6% per year in appreciation in the coastal states. So you're going to see more value increases in California than you're going to see nationally on average. So I find it 5 to 6%, but I'm going to use a low number and call it 3%. If you made 3% per year in appreciation for every $100,000 of purchase price, that's $3,000 in the first year that you are going to get in appreciation. You divide that 3,000 by 12 months, that's $250 a month in equity appreciation. Now, here's the deal. Some months, some years, you're going to have a 10, a 20, a 30% increase. And some years it's going to be flat or drop a little bit. But this is about how long you're going to be in the housing market. And historically, there's never been a 10-year period where you can look at what prices were at the beginning of that 10-year period and at the end. There's never been a period where prices have been lower at the end of the 10-year period. So if you're in this for the long run, no matter what the market does in the meantime, even how bad things were in 2007 to 2011, you're still going to end up with at least a flat line, if not some appreciation. But the other thing is growth compounds. This is something a lot of people don't understand. That $100,000 home becomes worth $103,000 in a year. Well, guess what? Now the $103,000 goes up by 3%. So it isn't simply just The 100,000 that you had $3,000 in average appreciation. So there's a huge value in compounding the increase in value of your home. But let's put it all together so I can dive into the actual details of this program. The tax savings is an average of 147 a month. The forced appreciation, 142 a month. And your average appreciation is $250 a month. That's $539 per $100,000 of purchase price. And if you're a higher net worth earner, you've got a much bigger tax savings. Even though you might not have mortgage insurance, you might not be able to write it off, your tax savings is significantly higher because you're in a higher tax brackets. So if you using this math, and this is just ballpark numbers for simplified explanation, whether you are talking to your best friend or a client, if you're a realtor, is to say, look, based on some numbers that I've seen, you get about $500 a month of wealth building per 100,000 of purchase price, which means if you buy a $500,000 home, you're getting about $2,500 a month of wealth building. That's more than half of your monthly payment. Now, don't misunderstand, that doesn't mean that you see all that money immediately, but over time, you are building an average of $2,500 a month on a $500,000 home. That's huge. And that's something that most people don't understand, other than when they talk to their friends who, I just sold a house and made $250,000 tax-free. Oh, well, they're lucky. They just got lucky in buying the house at the right time and selling it at the right time. I don't believe in luck at all. I think it's about setting yourself up for success and following a proven plan. And this is a proven plan. So now let's talk about how do we actually get people into homes that don't have a lot of money for down payment, which is really the reason why you're all here. I talked about $30,000 of free money for down payment assistance. The $30,000 comes from just a low end ballpark of a $300,000 purchase price that you can get 10% of that, or $30,000 in money towards down payment. And it's free because it's forgiven after 5 years. So I want to clarify the details of kind of what my title or subject was on this. Down payment assistance in general is money that the federal government or the state government has set aside to help people become homeowners. Most of the time you have to be a first-time home buyer. Most of the time you have to pay the money back. There's some exceptions to both of those things. And I'll explain in a minute, the definition of first-time home buyer is different than what a lot of people think. So first of all, how much can I get? Well, the program I'm going to focus on today is the Equity Builder program that gives you 10% of the purchase price as assistance, and it's forgiven after 5 years. There's also a program called My Home that gives you 3 to 3.5% of the purchase price. And there's a program called the Zip Loans, which gives you 2 to 3% of the loan amount as assistance. And we can mix and match these as appropriate. If we're doing the Equity Builder, we don't use any of the other two. If we're not using the Equity Builder, and I'll explain in a minute why you might not, that's when we're going to use the My Home or the Zip Loan. But the fact is, you can get 10% of your purchase price through the Equity Builder, and that's the program I'm going to be talking in more detail about right now. So do I have to be a first-time home buyer? The answer is yes. But what is a first-time home buyer? A first-time home buyer is someone who has not had an ownership interest in any principal residence or resided in the home owned by a spouse anytime in the last 3 years. So let me simplify that long sentence. You're a first-time home buyer. Your first-time home buyer status resets after 3 years of not owning a home. So if you owned a home before and you sold that home, and it's been more than 3 years since you sold that home, then you now are a first-time home buyer again. The second part of that sentence talks about residing in the home owned by a spouse, because it's kind of a loophole that got closed. And the loophole was, hey, let's buy one house and put it in the name of one spouse. And then 3 years, 5 years, 7 years, 1 year later, buy a house as a first-time home buyer for the other spouse. And they closed that loophole by saying, no, if you lived in a home that is owned by a spouse, then that's considered to be your primary residence, even if you don't have an ownership interest. So that loophole's been closed. But if you own a home and you sell that home, you can qualify as a first-time home buyer 3 years later. The other thing is you can own investment properties and you are still a first-time home buyer because it's principal residence. Now, it's rare that somebody's going to own a primary resident, an investment property and not own a primary, but it sometimes happens. So the devil's in the details, and so is the opportunity. And so it is anyone who's not owned a home, has owned their principal residence or resided in a home owned by a spouse in the last 3 years. By the way, guys, feel free to post into chat if you have any questions. I'll happily address those questions as we go. All right. So what's the catch? A couple of things. First of all, income limits. This program has income limits that will only allow qualification if you make less than 80% of the area median income. Now, I pulled some sample numbers per county, but even within a county, there's variances. So this is not what I'm going to explain is not going to be a fixed number for that county, but a sample from that county so that you can see roughly what we're looking at. In the sample, Sacramento is around 81,920. Now that includes El Dorado, Yolo County, and Placer County. Sacramento isn't just Sacramento, but it's the surrounding counties as well. I don't know, Lodi. So San Joaquin County is around $68,000 in income. The Bay Area can be as high as $120,000 in income. And you can qualify as being low income for this equity builder program. So this is definitely targeted, but I don't want you to just write off a client or a friend or a family member or yourself by saying, oh my gosh, I make over that amount, because there's a lot of options if you earn over the limit. The first thing is we can be creative because the limit is based on what we call qualifying income, not household income. Now you ask, John, what's the difference? The difference is I can ignore components of your income that we deem not applicable. Now, if your salary is $100,000 a year, I can't just deem part of your salary to be not applicable. Like you make $100,000 a year, it's a salary. There's no confusing it. There's no re-designating it. But if you earn other income, I'm not talking about second jobs per se. I'm talking about overtime. I'm talking about bonus income. I'm talking about commission income. We kind of use the rule that hurts us most of the time to our favor, because there's a rule when it comes to those additional incomes that says, well, you have to, in order to use overtime, I have to show a 2-year history of receiving overtime, and I have to get the employer to say it's likely to continue. Well, even if those two things are true, if I don't get proof of that, I'm not allowed to use the overtime. Same thing with commission, same thing with bonuses. So if we just don't document that the bonus is likely to continue, then we're prohibited from using it. So if you make $60,000 a year plus bonuses, and your bonuses are another 40, well, then you made 100,000, but I can ignore your bonuses and I can qualify you based on making $60,000 a year. The same holds true if you are married or you're buying with somebody else, and one of you is under the limit and the other one is over, or even if you're both under, but we can just ignore the other party. I had a client in my office last week that had exactly that situation, and one party had made about $110,000 a year. The other made around $70,000 a year. So $75,000 a year. They fit in perfectly. We left the party that had the higher income off the loan. The key was what price range they qualify for, and did that meet their expectations? So I'm going to get to that in just a second. We can also utilize the My Home Assistance program. So if you're over those income limits I showed on the prior page, you'll see the income limits again in a minute here. If you're over those limits, you can still get assistance. It just isn't as much money and it's not forgiven. So you're getting less assistance and you have to pay the money back. And in some cases, you're paying a higher interest rate because these programs come with lower interest rates. The state of California, through the California Housing Finance Agency, actually gives lower interest rates to the people that are under this qualifying income limit. So it's a total win-win. And I'll show you the income limit, or I'll show you the rates in a moment. So a lot of people ask me, John, how much can I buy? Well, let's run the numbers here. In San Joaquin County, the income limit is approximately $68,000. So if you made $68,000, you could buy a $375,000 single family residence, and your payment would be about $27.30 a month. that's based on 6.375 interest rate on a 30-year fixed, over 700 credit score with no other debts. So the problem was a couple months ago, 6 months ago, there were no homes at that price. We're seeing more and more homes at the lower end of the price range coming to market. And this is a huge opportunity to help people get those homes. Sacramento County, 81,920 can buy you an income, can buy you a $450,000 home. And that payment's about $3,300 a month. The thing I want you to be conscious of is that person in Sacramento County has to make exactly $81,000 a year and have zero debt to buy at $450,000. Not very common. We're going to find that exact person. But what is common, not common, you're going to be that exact situation and have zero debt. But maybe you make $75,000 and you have a little bit of debt, and we can qualify you up to $400,000 purchase price. So I don't want you to get your heart set on this price range, but recognize that the closer you get to this income limit with the lower amount of monthly debts, the better off you are. And the nice thing is you can use for a lot of people, they say, John, I don't need down payment assistance, but you have other debts. What if you got down payment assistance and you use the money you were going to use for down payment to pay off your bills? Now you've gotten rid of those monthly payments, makes it even easier to afford your monthly payment on the new mortgage. You're resetting all of your debt and putting yourself in a better position. I'm using this program quite a bit, even for people who have down payment. Matter of fact, the client I was just working with, we've got them approved on even higher purchase price than these limits because they're actually putting money down. You can use this equity builder combined with a 20% down payment of your own money. You can't put more than 20% of your own money, but you could theoretically put a total of 30% down using this program. 20% of your money, 10% from the assistance that's forgiven after 5 years, and your loan is based on putting 30% down, and there's no mortgage insurance. You're putting a huge down payment. So there's opportunities for us to be creative and using this to help people, not just those that don't have money for down payment, but we can help buyers. We can help you to purchase a home, even if you do have money saved, because you can keep that money in the bank to have for a rainy day. You can use that money to pay off other debt, or you can put that money towards the purchase and just have a bigger down payment and be able to qualify at even a higher purchase price than these figures. Because this is based on you coming up with basically no money out of your pocket. And I don't need any seller credits. In today's market, we actually have an opportunity to get a lot of seller credits. So maybe we combine this program and seller credits, and we can actually make it an even better deal for the client. So there's huge opportunity here to make this work. And I'm super, super excited about helping find a way to get more people into homes with this amazing program. But here's the key. Oh, by the way, Solano County, 86,000 is the limit. If you were at that limit with no debt, you could buy a $475,000 home. In the Bay Area, Alameda, Contra Costa, San Francisco, San Mateo, Santa Clara, you can make $120,000 a year. You could buy a $650,000 home and your payment would be $4,700. Matter of fact, I know somebody on this call right now who has a home listed in Alameda County that I think is a little bit above this price range, but if a buyer had some money for a down payment and they were within this price range, they could get an extra 10% towards their down payment utilizing this program. That might be a good reason to help list, to get that property sold in this market. So huge opportunities here. And I am helping clients think outside the box, not only in how we use the money, but also think outside the box and where you're going to live. Maybe you're trying to buy in Lodi or Stockton and your income's too high. Okay, well, guess what? You can go to Sacramento County. You can buy in Galt and you can qualify for this program because you have a higher threshold of income limits allowed in Sacramento County. Maybe you're buying in Sacramento County and you can move to Solano County. Maybe you're buying in Solano County and you can move to Contra Costa or Alameda County. There's a lot of opportunity to kind of shift across county lines and gain additional opportunity without really having a whole big difference in purchase price. And my best example of that is actually like the Tracy market. The Tracy market's tough because Tracy prices are really close to Bay Area prices. So if you got somebody looking to buy in Tracy, they're limited to $68,000 in income. But if they're willing to buy in Contra Costa County, I believe Contra Costa is at 120. Don't quote me on that. I know Alameda is. So they could go over the hill to Alameda County in Livermore, and they could buy a $650,000 home making $121,000 a year. So there are opportunities to drive a little bit further. You could have a significantly higher priced home. Obviously, the key is you got to start with your payment budget. So this is where I'm going to sit down with you or your clients and talk about what's your monthly payment budget. Sure, I can get you a house in Alameda County with your $120,000 a year salary at $650,000 a purchase price, but can you afford $4,700 a month? The key right now to buying today is making sure you can afford the payment today, even if it's a stretch. Sometimes we have to decrease how much we are putting into other savings. Maybe we decrease the money going into our 401k. Maybe we decrease the amount of money that we're putting into savings accounts to stretch our monthly budget. But by doing that, it allows you to have a payment you can afford today by decreasing money you're putting elsewhere, with the expectation that home ownership always gets cheaper. Think about that for a second. Home ownership always gets cheaper because over time, compared to rents are continually going up. When you lock in a 30-year fixed rate, that payment stays the same. Yes, your property taxes and homeowners insurance go up a little bit, but nowhere near as much as rent was going to go up. And we're at a upward tick of interest rates that everybody expects at some point down the road are going to come down some. How much lower, we don't know, but I think they're going to be lower than 6.375 we have right now, which means that you'll be able to redo your loan at that time and have a lower monthly payment. So there's an opportunity as long as you can afford the payment today. So all of this comes down to starting with your payment budget. How much can you afford today? How can we make this work for you? That's going to be the key to making all of this work. So how do we use the 10% down? Well, we use it for normal closing costs. We can use it to buy out of the mortgage insurance on a conventional loan, so you have no monthly mortgage insurance. We can use it not to pay off debt. That's why I didn't put it on here that way. But we can use it to supplement the funds you were going to pay for down payment so that you can use your money to pay off debt. We also are obviously using the remainder of the money for down payment funds. Depending upon how we structure it, you might spend anywhere from 3 to 6% of that 10% down, paying for closing costs, paying for buying out of the mortgage insurance, lots of different things that we might use that assistance money for. And then the remainder goes towards down payment funds. But it's all in the spirit of giving you the best possible monthly payment. So what are the repayment terms, John? All right, so the equity builder loan is forgiven after 5 years. So that's the 10% down payment. You don't have to pay that back as long as you do not sell or refinance in the next 5 years. That's critical to understand. You cannot sell or refinance in the next 5 years. What do I do if I sell or refinance early? Your loan is forgiven prorated based on 20% per year. So if you got $40,000 by buying a $400,000 home and you sell the home after 2 years, then your $40,000, you're forgiven 40% of that, or you get $16,000 forgiven and you still have to pay back $24,000. Here's one thing most people don't realize, but I do want to make it really clear. You will get a 1099 for the forgiveness. So you were given money that you didn't have to pay back. The IRS considers that to be income. The IRS says, hey, anytime that you owe somebody money and you don't have to pay them back, well, then that's income. That's money that you earned. We want our share of that in taxes. So just be aware you will be given a 1099 as a debt forgiveness income that you're going to have to pay taxes on. So what's next? First of all, I'll have time for questions. So if anybody has questions, feel free to post them into chat, or you can unmute yourself and we can ask them live. But really what's next is give me a call. If you're a home buyer who's looking to buy, we can set up a consultation to talk to you one-on-one. If you're a real estate agent, give me a call and we can talk about how to show this program to more of your buyers and how to use it on your listings to help get listings sold. So you can call me, you can email me, or if you want to start the process right away, you can just go to apply.johnloneking.com.